Great. Thank you, Mr. Chair, and welcome to the folks testifying before the committee. We appreciate your time, especially want to have a welcome for Ms. Norris, a graduate of Miami University in my neck of the woods in the state of Ohio. So I appreciate you all being here. I want to focus on the California model and whether there's just something sort of fundamentally broken about the way that California regulates its insurance market. I mean, if you sort of step back, and we all agree that we want people to be able to afford home insurance, whatever their station of life and however much money they make, there are two sort of ways to do that. One is to help lower income people afford insurance in a market that is reasonably regulated and actually operates effectively. Another option is to try to regulate the market such that it can't actually function properly, and so it doesn't actually provide the benefits that insurance is supposed to provide. And I worry that California has gone down that pathway, and that we're frankly learning, or we risk learning the wrong lesson. So I want to direct my questions first to Mr. Theodoros. Thank you for being here. Theodorou?
That's right.
Theodorou. Okay, sorry about that. Could you maybe just explain Prop 103, what it changed about insurance regulation in the state of California?
Sure. In 1988, Proposition 103, a ballot proposal was passed by a slim margin in California, and it gave a 20% rebate to automobile insurers. It introduced the intervenor process where parties could argue for rate decreases. It established a deemer provision, which indicated that the insurance department would respond within 60 days, something that hasn't happened. So those are the three main things, and prior approval of rates.
Yeah. And sort of, am I right that the regulatory regime that's sort of come out of Prop 103 is very backwards focused? In other words, insurers are focused on accidental loss, casualty loss, and so forth that's happened in the past. That's what they use to set insurance rates, as opposed to forward modeling for future risk.
Yeah, those were two statutes that are introduced. One that prevents them from using the recent experience of catastrophes, the last 6 years. And there's another statute that prevents the use of incorporating reinsurance cost. Reinsurance is part of the cost of an insurance company. So those are two other provisions in the California statute, which are in addition to the Prop 103.
Great. Thank you. Mr. Heller, I want to sort of direct this question to you, and it sounds like you want to say something. Feel free to do so long as we have the time. But one of the arguments I've heard is that the reason insurance rates are so high in California is because of the threat of climate change, which, of course, places that are closer to the oceans, theoretically going to be more at risk to climate-related disasters. I guess my question here is, how can we credibly argue that climate risk is what's driving California's insurance market when they're more backwards looking than forward looking? Of course, the risk to climate change is in the future, not in the past. And second, you see all types of casualty insurance rates going up. So it's one thing to say property insurance goes up in response to climate risk. It's a little bit harder for me to swallow the idea that auto insurance would go up in response to climate risk. And yet that's exactly what we see in California.
Thank you, Senator Vance. And I'm a Californian. I've been working in California insurance market for over 25 years, so I appreciate the opportunity to focus in. I'd like to just start by just noting there's real misinformation here, because from 2019 to the present, California, and I really want you to hear this because it's very important, California has been one of the most profitable homeowners insurance markets in the nation, vastly more profitable than the country as a whole. So when we say that companies are leaving, that is, they're not leaving, they're kind of cutting back on their business. But it's not because they haven't been able to make the return that they've asked for. They have actually done better in California. And over the since 2021, they've received 95% of the rate increases they've requested in the regulatory system that does work, but also allows public input, and that's been so critical. So I just want to make sure we're on the table.
And is that profitability, Mr. Heller, because they've effectively left the riskiest markets and focused on the most profitable markets?
No, that's profitability because California has given them the rate they need, and California has invested over $2 billion in wildfire prevention. And we have done the work in California and used the regulatory protections for consumers to ensure that prices were escalating as they needed to be, but also maintaining the protections. And you mentioned, so I wanted to answer the other question you mentioned, which was this pass-through of reinsurance costs. Well, we've talked about the fact that reinsurance markets are right now escalating to the highest point they've been in over 30 years. And California does allow insurance companies, there is no statute, as Mr. Doro said, there's no statute that prevents them from buying reinsurance. They can't pass through the excess above what's actuarially indicated onto their consumers. Now, in states that do allow the pass-through, states like Florida, Louisiana, Colorado, the insurance premiums are much higher than California, but they're also seeing withdrawals from the market. They're also seeing companies underwriting out certain communities. The pass-through of reinsurance allows the insurance companies to be free from that exorbitant international unregulated market, but it does not protect consumers from withdrawals. That's happening everywhere, irrespective of this pass-through.
Mr. Chair, I know we're running low on time, but could you just address the climate question, specifically in relation to auto versus property insurance rates?
So, well, climate does impact auto to a degree on the obviously on the comprehensive policies, but that's only a portion,
right?
Yeah. So, first of all, I disagree with the fundamental point you said about climate being a coastal issue. The derechos that are going through the Midwest are linked to climate change, and that's driving some of the highest rates. I mean, climate change is hitting everywhere, so I don't want to mistake this as a coastal issue around the country. It's really a national issue.
Sure, but I think
but the
we'd all
auto
agree,
insurance,
California is probably more at risk from climate disasters than the state of Ohio. And
that's,
as an Ohioan,
Ohio's a great place to be. Absolutely. The auto insurance market in California is not different than the auto insurance market we're seeing around the country. Now, the one thing is that auto insurance in California, because of the protections from Proposition 103, prevented insurance companies from getting as much of a windfall during the pandemic when we were all stuck at home not driving, whereas around the rest of the country, companies kept on charging as though it was 2019, even though we were all stuck at home. So now there has been inflationary pressures because of car repair costs that are independent. They're more driven by COVID, post-COVID, I think, than climate change. So we are seeing rate increases in California. But as the Washington Post just reported the other day, those rate increases are as severe around the country. It's not a California-specific thing, and it's by no means related to the regulatory oversight and consumer protections of the state.
Senator Vance.
Thanks, Mr. Heller.
Thank you. Time expires. Senator